And I think one of the most powerful use cases and things that stablecoins could do is basically eliminate and kill the need for pre-funding. That if you can move money 24/7, if you want to fund a payout across the world, you could just send us a stablecoin in the balance that you want to fund. We can receive it on a Saturday and then initiate a local payout via RTP. But to do that, we need great partners. We're building world-class crypto treasury infrastructure. And so companies like BVNK are playing an important role in helping us do that. And I hope that a few years from now, the term pre-funding is just like archaic, like what we used to do that. Like we used to have to plan ahead. And I think we're kind of on the path in that direction.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of tokenized real-world assets. My name's Simon Taylor. I'm your host for today. I'm author at FinTech Brain Food and head of market dev over at Tempo. As always, I'm joined by the fantastic, the phenomenal Kai Sheffield, head of crypto at Visa. Kai, how are you feeling, sir? I know you got like a dentist trip coming up later, but are you ready for this?
I feel good. It's a toddler dentist trip. That's a different type of dentist trip, but I am great. There is so much going on this week. 2026 is off with a bang. We got a lot to break down today.
We do, and we've got a great guest as well today. Joining us is Michael Tannenbaum, who is the CEO of Figure. Welcome to the show, sir. How are you?
Good. How are you? Thanks so much for having me today.
No, I'm really excited to have like a fintech OG. You have a background in SoFi and then Brex for a long time, and now at Figure. So I think you're perfect for our audience, and we've kind of been on a similar journey to a lot of folks. So before we get into the stories and content, I just need to remind viewers and listeners that views and opinions of our contributors today are their own and might not reflect those of the companies they represent. And please don't take anything we say as tax, legal, or financial advice. Always do your own research and speak to a professional if in doubt. And also, I got to remind everybody that this episode is brought to you by our friends at Centrifuge. Tokenized is also brought to you by our friends at Centrifuge. Through every crypto cycle, Centrifuge has been building, and today they are the market leader in tokenized real-world assets. Back in 2017, they were one of the first to mint a stablecoin backed by real-world assets with Maker. They're now launched an RWA lending capability with Aave, which is over $1 billion in total value locked. And Centrifuge works with major institutional partners to tokenize and distribute their funds. From treasuries to credit strategies, Centrifuge connects traditional finance to decentralized markets, creating new ways to access and put capital to work. Centrifuge is more than simply part of a tokenization wave. They've been kind of driving it in many, many ways. Whether you're an asset manager or a fintech exploring tokenization or a stablecoin allocator seeking high quality institutional yield, look no further than Centrifuge. Thank you to our sponsors. Story number one, Kai, I'm going to come to you first on this. We do have a snippet coming up from the BVNK co-founder, but I couldn't escape this news this week. BVNK is going to deliver stablecoin infrastructure for some pilot programs in Visa Direct. This is, of course, Visa's $1.7 trillion money movement network annually. And BVNK also received Visa Ventures investment in May of 2025. So before I get to Kai, we were lucky enough to hear from Chris, so we're going to throw to that now. And in a tokenized exclusive, I am with Chris Harms, who's the Chief Business Officer at BVNK, to talk about a huge announcement, which is that BVNK will now be powering stablecoin payments for Visa Direct, its $1.7 trillion money movement network. So, Chris, take me inside what you're doing with Visa, what's Visa Direct, and what's this partnership about?
Yeah, Simon, good to see you again. Look, we're super excited about this. So Visa Direct is obviously the payments arm of Visa. It's their money movement business. So it's actually where they are in the money flow, not just providing the card rails that everyone knows Visa for. We've recently announced that we are powering 2 use cases for Visa Direct. The first one is allowing all Visa Direct customers to fund their payouts, their fiat payouts, in stablecoins. And then secondly, we will be adding a stablecoin payout endpoint into the Visa Direct network, which means today, if you're a customer of Visa Direct, you can pay out You could do a push to card payment. You can do a push to digital wallet payment. You can do a push to account payment. BVNK will be powering that push to stablecoin wallet payment for Visa Direct. So it's pretty meaningful. We're super excited. We think it's Visa leaning into stablecoins even further. They've got a couple of initiatives on the go, and we're going to be powering a core block of that being Visa Direct.
Do you know, push to stablecoins was almost the perfect framing for it, because I'm used to push to card and push to account. And people forget that banks use Visa Direct to send money around the world on behalf of their customers. It's something that banks use, and indeed many fintech companies use, to load wallets, to really do a lot of payments activity. But that stablecoin endpoint, I can't push to a wallet. So what would that look like now for a Visa customer? What are they able to do that's a little bit different to before? And are they buying that directly from Visa? Are they coming via BVNK? What does that partnership look like?
So this is we providing Visa with the full stack, including the compliance capability, the liquidity, as well as the orchestration of those payments. So any Visa Direct customer will come; they'll use the same APIs that they used to with Visa, but now there will be an additional option. Instead of saying, "Hey, pass through Joe's bank account details," it will be pass through Joe's crypto wallet details. We'll collect those details. BVNK does all the transaction monitoring. We screen that beneficiary wallet. We make sure that it's not sanctioned, and do all of that compliance. And we take care of all of that. And then we do the conversion from fiat into stablecoins, and we pay out into that stablecoin wallet for that Visa Direct customer. So think creator payouts, as you mentioned. Think remittance payouts. Think insurance payouts. Any payout that's done through the Visa Direct network now can now be done through stablecoins powered by BVNK.
And then talk about sort of somebody who's like a bank customer that wants to have the instant settlement capability that you talked about as one of the other major use cases. We've talked a lot about pre-funding and some of the challenges with instant settlement. And Visa announced a little bit earlier in the year that they're working with Lead and Cross River around some of those 7-day settlement pieces. What does this look like with Visa Direct and BVNK?
Yeah, so it's a great question. So I think we have to separate Visa's card network business and their stablecoin settlements that they're running there, which I think is approaching 4.5 billion in settlement volume. And that is really Visa's issuers, card issuing customers like the Lead Bank, like Cross River, now settling with them with stablecoins 24/7, 365. If we move over to their money movement business, if we think about that money flow, Visa Direct's customers would bulk fund them in dollars, and then they would pick up those dollars and pay out across the Visa Direct network to these endpoints, whether that be. So that original funding, if that customer was not in the US and couldn't fund one of Visa's, on a domestic instant rail like an RTP, and needed to send a wire to fund their global payouts, we are now enabling Visa to accept stablecoins as part of that funding mechanism to fund any sort of payout, whether that's a push to card, push to stablecoin, push to bank account payments. So it opens up two sides of the flow. It allows them to fund in stablecoins for quick funding. It also then opens up, push to stablecoin payments or payouts for Visa Direct customers.
Get funded and pay out directly. So what are you looking forward to in this partnership? And when's this live? Can customers buy it today?
Yeah, it's gonna be live. Final testing is commencing. There's a whole host of customers live, or about to go live, or in onboarding. So we're looking like the launch is going to be a public launch in January. So we're super excited about that. We've kind of got a tacit handshake agreement. I think Visa doesn't get excited for anything less than $1 billion in TPV. So hopefully target is $1 billion of TPV in the first 6 months. So we're pushing hard with the Visa Direct team to make sure that gets enabled, and we really support the team to get this live and in the hands of as many customers as possible.
Well, if people are interested in it and they want to talk to you a little bit more about it, where do they go to find out more about you and everything you're doing at BVNK?
They can find us at bvnk.com, and they can find me on LinkedIn at Chris Harms.
All right. Thank you, Chris. And thanks, everybody, for watching this little snippet here with breaking news. And thanks, Chris, for giving us the exclusive. Chris, thank you so much. Kai, you heard from Chris there. I thought he had a really nice framework about push to card, push to account, push to wallet. Anything you want to tell us about this from the Visa side?
Yeah, just really excited about the partnership with BVNK. They've been a great team to work with. And And I think that the use case, the thing that I'm most excited about is this idea of being able to do stablecoin funding of our broader payout capabilities. And this concept has been around. Anyone in the money movement business knows the term pre-funding. And it's kind of this dirty word.
Yeah.
It's like, oh, you gotta pre-fund, and we gotta plan ahead and figure out how much volume we're gonna do over the weekend. We gotta make sure we hit a wire cutoff time, and it's just that's the way the industry has worked. If you want to be able to send money cross border, you have to pre-fund. And I think one of the most powerful use cases and things that stablecoins could do is basically eliminate and kill the need for pre-funding. That if you can move money 24/7, if you want to fund a payout across the world, you could just send us a stablecoin in the balance that you want to fund. We can receive it on a Saturday and then initiate a local payout via RTP. But to do that, we need great partners. We're building world-class crypto treasury infrastructure, and so companies like BVNK are playing an important role in helping us do that. And I hope that a few years from now, the term pre-funding is just like archaic. Like, what, we used to do that? Like we used to have to plan ahead, and I think we're kind of on the path in that direction.
Michael, opportunity for you. If you've in your SoFi days or Brex days had to deal with pre-funding, what do you think something like this would have meant to you back in those days?
I think it's a super interesting point. And as you talk about pre-funding, is bringing me back to the early days of Brex, where at Brex, we actually, when we started the company, we were on Marqeta, which only offered prepaid debit, which is a version of pre-funding. And the reason why Brex started to take off is we basically abstracted the pre-funding from the customer. So we, Brex ourselves, pre-funded the Marqeta account on behalf of our customers and then made it a credit card like. It was a prepaid debit plastic, because there's a lot of payments folks on the call. So it functioned as a prepaid card in terms of the network, but we abstracted that from the customers and made it a credit card. And that actually was a huge reason why Brex took off early on, because ultimately, to the point, people want credit. They don't want to pre-fund. They don't want to think about that, even though it's not that big of a deal to go and allocate funds up front. It's just not what people want. And there's a reason why credit cards are popular. And even a debit card, right, it works against what is essentially a pre-funded bank account already. You don't have to change behavior. But the behavior of pre-funding things is just so anathema to consumers and businesses that absolutely, had there been that stablecoin option, you could kind of get around all the acrobatics Brex had to do early on to address that pre-funding. So that's what came to mind first when I was hearing that anecdote.
Yeah, no, great to give it an operator's perspective. So thank you for that. And speaking of operator's perspective, I'm going to pull us to our next story now, because just a day ago as we're recording this, and a few days ago as you're hearing it, Figure announced the on-chain public equity network, or Open for short. So Open equities are blockchain registered, not a tokenized version of depository trust and clearing corporation securities. So they're natively registered on the blockchain. And the goal here is to reduce the cost and capital requirements mandated by the DTCC from your press release. And this includes, you get self-custody, which eliminates the need for custodial brokers, potentially reducing costs. You can even do margining through DeFi to enable cross-collateralization and replacing a lot of the stock, borrow, locate process with a transparent limit order book. So I'd love to step through all of these. I know you've recently been through an IPO. You've had some experience of going through the traditional listing process. What is this product? Who's it for? And what are you hoping to see?
So when you think about Figure, we're known for seeding out marketplaces and doing that in a greenfield way. We started in the consumer credit space. We're well known for what we've done in tokenized RWAs, specifically mortgage, and we're the market leader in that. We've done about 20 billion, and we have a huge network of partners that originate mortgage assets with us on a blockchain into a capital market, and we take a ton of time and cost out of the system. And so that was kind of marketplace one. And then marketplace two was crypto DeFi. We launched a product called Democratized Prime, and which is today essentially a large DeFi warehouse line in some ways, right? So it's a short-term asset marketplace for tokenized assets, and you can borrow or lend against them. And that started to grow really nicely. And an example of that would be one of our partners that, say, does the tokenized mortgages with us. If they want to borrow, they can do so at rates that are more attractive than warehouse lines. And so that's Democratized Prime Marketplace 2. Marketplace 3 is equity. And the reason I start with the others is to kind of explain how we try and use blockchain to add real value into the real world and take out time and cost. And so you think from an equity perspective, while that market does work well, it works better than debt, right? It's more liquid, it's more standardized. There's a lot of economic opportunities that are not afforded to the asset owner in equity. And so one thing that I like to say about kind of what we do more broadly is we do for asset ownership what the internet did for content creators, right? So we're turning over the economics of asset ownership and origination to the people that actually own those assets or create them. And so from an equity perspective, today, some of the things you mentioned, Simon, is that there's not only a lot of costs in the system, and us doing a blockchain-based approach to equity is going to reduce those, get that transactional benefit of blockchain. But I think even more importantly is this concept of controlling the stock loan. And I'll be specific about that. So when we launched Democratized Prime, that short-term marketplace, we called it that because we were going to go after prime brokerage. And so in today's financial services landscape, you artificially have people that lend against debt and people that lend against equities, and there's not this cross-collateralization. And that gets to why it's so important to do a true blockchain native approach to equity so you can get that liquidation in the event of a problem, right? You have pure lean perfection into the asset, and you can you can sort of confirm ownership and custody rather than relying on a trust-based process. And in the aggregate, that's going to result in higher leverage and cross-collateralization. And so as an example, if you own a tokenized equity and you're custodying that equity yourself, you can control when someone wants to borrow that and control those economics on that borrow. So just whenever people are shorting a stock, they're borrowing that stock and they have to pay to borrow it. And when that, depending on how in demand that borrow is, right, how much short interest there is, essentially, interest in borrowing that stock, it can be really material economics for people that own the stock. Because if lots of people want to short it, in some ways you're getting paid to hold that stock. But today, you're not really getting paid to hold that stock. The prime broker is sort of intermediating that. And that's why I got back to that point about same sort of thing the internet did for content creation. We are using blockchain to do that for asset ownership and saying, well, you might as well control your own equity. And when you do so, you should get the benefit of lending it out. And you should also get the benefit of cross-collateralizing it. And that's kind of how all these marketplaces fit together, because we're really taking a blockchain purist approach to assets that are, obviously we started in debt, but also now equity.
Yeah. First off, congrats on the announcement. So many interesting things to unpack here. So let me
definitely
start
don't
with
lack for complexity.
Let me start here and just ask the dumb questions, obvious questions. Is so who is this for from a company standpoint? Is it existing companies that have traditional forms of equity that go through the DTCC that are kind of traded the way that it works right now, that would also create a blockchain native approach to equity, and then the equity would kind of be split between these two form factors? Or is it new companies who, instead of when they IPO going the traditional route, they would go this route? What's the ideal company of when and how they would do this? And then is it mutually exclusive where it's that's the only version of your equity, or you can have both a traditional version of equity and a blockchain native version of equity? How does that work?
It's both. So for Figure today, we are launching a second QSIP, or essentially a second share class of our equity on a tokenized approach, right? On open, essentially. And what we're doing there is It's a new S1 because we're a recently filed issuer that then will be traded on Figure's ATS. And as part of this open network, you can either self-custody or use BitGo as custody. That's what we announced. And there will be market makers making sure that there's liquidity, and they will also be ensuring that the price stays in line with what's going on NASDAQ and the NMS security. And so you can also readily exchange through Figure Treasury one for the other. And so if that's going to help bridge from kind of 0 to 60, obviously we believe and are confident that there's a lot of benefit owning your stock on chain, the tokenized version. But there's, of course, going to be people that want to be able to move between the two, and we've set up Figure's Treasury to do so. So that's how it works for us, and other companies can do that way as well, almost like an ADR, right? When you're coming up with a new share class, that's so anybody who's sort of an existing publicly traded company can do that. And then as part of a future IPO for a company, we envision that investors are going to start to demand and want this tokenized approach to equity. And as a result, just like when Figure did its IPO, we allocated a portion to retail, right? There's a time at the IPO where the issuer says, I'm going to give this much to this people, I'm going to give this much to my friends and family, and I'm going to give this much to retail investors, and these are the pockets. There's also going to be, well, I'm now going to allocate this much to tokenized stock. And that is absolutely coming, in the coming months. In terms of part of your question was like, well, who's going to do this? So in general, the first movers and the early movers are going to be those that stand to benefit most from this and or are sort of blockchain adjacent, right? So think about DATs as being a natural place. People that are in the ecosystem already, meaning crypto exchanges, people that are custodians, people filing for or recently IPO'd. Anybody who has a lot of short interest in their stock, I think this would be an interesting place to go, because I think investors that are standing by you will naturally want to control more of that economics. So that's going to be a place to go as well. And so, we're going to have this business development effort towards this. And I think the benefit, I know for me, having just gone through an IPO and thinking a lot about retail, I also think this gets into the question of governance and voting, where you see a huge blowback today against folks like ISS, right? The proxy process and the lack of transparency. People across the equity ecosystem are criticizing that. And that's another benefit that I didn't yet mention about doing this on chain, is kind of more transparency, lower costs. Think about all the paper and the constant emails that you get to alert you of a vote, and just having that be managed by your own wallet is just so much simpler. And so that's also going to be an avenue for us to make inroads and get into that conversation, especially because so much of the conversation today is against those proxy firms, and there's a lot there.
There's so much that could be beneficial here, but what I think's nice is this pattern that you've developed with the HELOC kind of mortgage marketplace that you built. You sort of built a business that could have been a perfectly fine business in mortgages, but you happened to do it on a blockchain so that you could turn it into a marketplace. And then with Prime, you did the same thing, where you could have built that the old-fashioned way, but you did it on a blockchain to almost instantiate it. And now by issuing your equity onto Open, you're sort of taking the leap first. You're sort of showing that we can do it so that others might follow and build kind of a business around it. And when I heard you say ATS, I mean, many listeners will know this, but some won't realize that a regulated ATS, or alternative trading system, operates under SEC rules, meaning you're sort of following everything that a stock has to follow to be SEC regulated. So this isn't like you've done some wild blockchain scary thing. This is SEC regulated if you are an ATS. And therefore, you then get these other benefits of self-custody and cost reduction. But one of the things that's running through my mind with the proxy voting was that most people don't realize that when you hold a bunch of stock through your Robinhood or brokerage and Schwab, that you potentially are missing out on a bunch of voting that you could be doing at the AGMs, annual general meetings. And they might be voting on all kinds of policies. Should we put in a new CEO? Should the management teams get their bonuses? Like all this kind of stuff. And
Totally.
there's like there's like 2-3 companies that do all of this, and it's just outsourced to them. I saw about a week ago, JP Morgan has decided to stop doing that, and they're using an internal AI tool to like help recommend some of this stuff internally, just because those things are considered like such a centralization risk. So that is fascinating that once you've created this new system, you can start to unlock these new benefits for users. But I'm curious though, like as you've instantiated this, like 99.99999% of all public stock lives on the DTCC. Are you seeing demand now to come into your open network because of some of the challenges that they have with some of those things?
Absolutely. And I think that the point that you raised about our own inventory is a huge one. And that's a real credit to Mike Cagney, the founder, co-founder of the company, because repeatedly throughout Figure, and since I've been at Figure, I've kind of taken this mantle of being comfortable giving up near-term economics to build out these marketplaces. And so we have to seed this equity out with our own offering, as you noted, because it's really hard to get people to do things that have never been done before. You kind of need to do that first. And so by showing the way and showing that it can be done with our own stock, to your point, that is absolutely bringing people that are interested in doing this. And to be interested in doing this, you don't necessarily have to be an issuer. Of course, issuers are going to be the ultimate arbiter of the inventory. But for example, for Figure, we're seeing our own investors that already own our stock saying, yeah, we want to move our existing Figure stock to this platform. Right, which is absolutely
because then
possible.
They'll be able to get the economics if somebody shorts it. Because in order to do that, they have to borrow against it, and if you're borrowing against it, who gets the yield from the borrow? Sort of looks like a morpho vault to my mind. Like some listeners will be familiar with on Coinbase. They have this ability to sort of park your Bitcoin in a morpho vault, and then you can borrow against that, or you can just simply earn yield from it by parking it there. This is that same concept, but instead of applied to your Bitcoin, it's applied to the investor's equity that's sitting in there. And if somebody's borrowing to short the stock, it's quite nice that you're getting paid as somebody who believes in it for the privilege of letting them borrow against it to short it.
Yeah, I think one major takeaway for me that I've heard Mike Cagney say multiple times on like different podcasts, which really stuck with me, is when you think about the value proposition for issuing equities natively on chain, I think that the first thing that a lot of people started saying, and people have been talking about this for years, was 24/7 trading like all over the world.
Right.
That was like the value prop. And crypto people are like, crypto trades 24/7. It's like, why don't equities trade 24/7? And so shouldn't we put all stocks on chain so they trade 24/7? And it sounds like, if I understand correctly, that like that's not actually that big of a problem or value proposition of like 24/7 trading. The much bigger value proposition is really on-chain finance, DeFi, credit. It's
Absolutely.
the ability, once you have self-custody of an equity, that you can lend it, you can borrow against it, you can do all of these things with that equity that you can't do when it sits in an existing database. And so it seems like this is you guys proving out like all the things that you can do with that equity, rather than, I don't see anything around like just trade it on the weekends, like Sunday at 3 a.m. Like that's not the reason to do it. Would you agree with that?
No, I think it's well said. There's two kind of points that you're implicitly making there. I think there's the point about like where the market is moving in terms of prediction markets, meme coin. Like there's that sort of whole factor which has been merging with crypto and blockchain, right? And I think for Figure, we've generally taken a little bit of a different approach, which is a more fundamental, how do we use blockchain to add value in the real world? And I don't necessarily, while I think it is strictly better probably to have trading at all times than not. I don't personally, and I think Figure, Mike, all of us don't really view that as a really like latent demand and something that's going to fundamentally change the world. But I think going through the counterfactual is actually valuable here, because if you think about what some people have decided to do, and this gets to the point of liquidity, which is that whole marketplace point I'm making, you need liquidity to make this all work. If you, let's say you were to tokenize OpenAI as an example, right, which has been discussed. And in doing so, you're basically saying there's going to be some ultimately paper-based process or some electronic share certificate living in some software. And then you, as a buyer of that tokenized equity, sort of like that version of that stock, I guess if that's tokenized now, I guess you can trade it 24/7. I don't know how many people want to trade OpenAI 24/7 or if the price is moving that much. And then at the same time, to the point, you don't really have visibility into that equity. Like, how do you know that you actually own it? How do you lend against that? If the borrower defaults, where do you go to collect on that? And is that happening over, a series of legal lawsuits that are happening for months, right? And so it's very different than what we're proposing. And I think, to the point, yes, DeFi is absolutely, where we're headed, and you need that lean perfection and you need that blockchain native security to do that.
But it's just a big old marketplace, isn't it? I think that's what's fascinating here. I was listening to Austin Campbell, friend of the show. He was talking on the Crypto in America podcast, and he was recounting that DTC was never intended to be a monopoly and 100% market share. It was just the best way to solve the problem they had in the 70s, that there was too much paper. And the way they did that, of course, as you well know, is with dematerialization. And so the stock certificates just were immobilized, and the rights and obligations are what become something that people buy and sell. And of course, the DTC is now doing that through their tokenization initiative, that it is the rights and obligations, but it's not necessarily the stock itself. So what you're doing is quite different to that. But there's an interesting thread here from like Silicon Valley. I'm a big fan of Bill Gurley, who you're probably familiar with, and he's been talking for a long time.
And his thoughts on IPOs, for sure.
He has lots of thoughts on IPOs.
Yes.
I don't know if you've spoken to him or others that are considering IPOs about some of those challenges and about whether there's an opportunity to change that. And are they put off by the blockchain nature of it, or do they just see, actually, no, this is a better thing and it's regulated?
So I think, Simon, it was so valuable for us to go through this process of blockchain equity after the IPO that we just did, to your point. And there is kind of this, even retail allocation, when we were going through it for Figure and deciding how much we wanted to allocate to retail, we did more to retail than I think, I don't know about ever, but certainly we had a very large share of allocation to retail, and it was a very uncomfortable conversation with the underwriters on the IPO. It was obvious that it made them uncomfortable, and there was just this. And if you think about like how an IPO would work on blockchain, right, it would be that you would potentially just be going right to someone's phantom wallet, right, as an example. And so it would be very disruptive in some ways to the process that happens today. If you so it's almost like if you think about going to the clubby world of a few mutual funds in Boston, to then expanding it more broadly to all institution, to then expanding it to retail, but intermediated through Wall Street banks like Bank of America, Merrill Lynch that have big, or Morgan Stanley that have big retail. And then now Robinhood, SoFi, Public, right? Those are options. We used many of those for IPO, but then to be able to say, well, I'm just going to go to a wallet directly on chain, like that's so it is very disruptive to the IPO process itself. And I think retail is a version of that, but it's not all the way to direct to the wallet, right? And it was absolutely like we were getting kind of unclear pushback. Well, we really don't recommend allocating this much to retail. Why, right? There's no real answer. And then it was a huge amount of pressure to allocate to the big mutual funds, right? That you're probably familiar with, and they're supposedly long oldly, but the world is really changing, and I just think that the IPO process is absolutely. Look, we're grateful. It was a great IPO. I'm grateful for the underwriters. They did a good job. Like, I don't want to sound disrespectful because I'm not. However, we do see a new opportunity for this to be done better with lower costs and, frankly, with a stronger relationship between issuer and shareholder. And ultimately, like that that is, as an issuer, that's what you want, right? You want a relationship. We're talking about voting and quorum, but like you want to have that direct relationship with your shareholders and get them have the economics.
So one last quick question before we let you leave on this one. I think Kai, you wanted to talk about the infrastructure itself.
Yeah, I think when you talk about like issuing equities on chain, then the natural question for the crypto folks is like, okay, well, which chain and why? And so my understanding is you all have built your own chain in Provenance versus using existing ones. Can you talk a little bit about like that decision of like why not just use Ethereum? And then were there specific features or considerations around what makes Provenance, the right chain for this versus Canton or Ethereum or others that are out there?
So we build on Provenance, which is a public L1. It's not a private blockchain, but it is. We have about 25% of the hash token, which is the native token to Provenance. And when we started building on Provenance back in 2018 and created it, the founders of Figure were the creators of Provenance as well. That was a much different time for the blockchain universe. And at the same time, I think we wanted a proof of stake blockchain that also had the privacy support that we would need for doing consumer loans on chain and being able to handle that. And so that was a big part of it then. And then since then, we've just always built on Provenance. It's been a great partnership and useful for us. But as you've probably seen in the past couple months, we've done a lot more on other chains. And so we've used our stablecoin Yields, which is an SEC registered yielding stablecoin. It's now actually the number 3, I think, for yielding stablecoins. And we've used that to bridge into other ecosystems, including Sui, Solana, and Ondo. So I think similarly here, while Provenance is what we're building on, we imagine, especially for the DeFi financing world that we're building on, to be cross-chain. And as you well know, Kai, the world is such that there's lots more L1s today than there were, call it, even 2 years ago. And so as that kind of proliferates, I think our focus is making sure that wherever people are and whatever stable coins they're owning, we want to make sure that they can be a part of our DeFi ecosystem as well.
I think that's fascinating how the meta on crypto Twitter right now is all about privacy and privacy chains. And since Canton and everybody's seen the size of their RWAs with Broadridge and have realized that privacy is going to be a really key thing to unlock these mainstream use cases. So sitting there in 2018, there weren't a lot of good choices for that. But as you say, that's sort of changing. So it's good that you're remaining flexible on kind of all of that stuff. I'm going to pause this here. We're going to hear from our sponsors and we'll be back shortly.
This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's Tokenized Asset Platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP.
This episode is sponsored by Stripe. Here's the thing. Selling digital goods globally is still far from easy. Many of the people around the world that want your product don't have an easy way to pay you. They simply don't have access to cards or a bank account. Stablecoin payments change this. They're the first truly global payment method that you can use from anywhere. That's why, for any business with global growth ambitions, accepting stablecoin payments is table stakes. With Stripe, doing so is as easy as flipping a switch. From big names like Shopify to fast-growing names like Shadeform, businesses everywhere trust Stripe to accept stablecoin payments from everyone, everywhere. See what's possible at stripe.com/crypto. All right, thank you to our sponsors. The next story we had this week was just about everywhere in my feed as well, which is the Senate Banking Committee vote on the crypto market structure bill, which was scheduled for the 15th of January, has been delayed due to many of the crypto lobby pulling their support. This follows a draft bill in the Senate Banking Committee that had a number of challenges. For example, the CEO of Coinbase, Brian Armstrong, in an X post claimed that it has a de facto ban on tokenized equities, DeFi prohibitions that would give the government broad access to user financial data, an erosion of CFTC authority, and eliminating the rewards on stablecoins. And I think it's that one that the bank lobby has had a real issue with. Meanwhile, Bank of America just did their earnings call, and we heard from Brian Moynihan, the CEO there, who was essentially saying that they believe there's a real risk here if the current situation where stablecoins don't give yield directly from the stablecoin issuer. Somebody like a Circle, though, can partner indirectly with somebody like Coinbase, and Coinbase can offer rewards. And that is seen by the banking lobby as a loophole. So one of the associations in banking has said that they expect there could be up to $6 trillion of deposit outflow. This would mean there's less fully reserved money, and banks would lose capacity for lending, and sort of especially those smaller community banks. So this is kind of fascinating. This crypto market bill feels like a big, complex one that could be a ways off. It would need to get through the banking committee for the SEC side. It would then need to get through agriculture for the CFTC side, and then we might get to something that could hit the Senate. But this one could run for a lot longer yet. Michael, interested in your thoughts on this. I know regulatory clarity is not always easy. I know there have been similar jurisdictional battles in traditional markets, but would it be helpful to have something like this pass? And sort of what are your hopes for your business?
I think it would be helpful, and you can't ignore, regardless of kind of opinions of the administration broadly, the helpful tailwinds that we've gotten from and the regulatory clarity. I think here, and forgive the pun on clarity, I think for me, the one thing that I've been watching is just kind of the DeFi in particular and regulatory exemptions for that and clarity there. And I think it's, we've been having conversations about self-custody and just trying to make sure that people have, DeFi is a little bit ambiguous, and and so I think for us, that's what we're mostly watching there and trying to understand exactly what is and is not required. And I know it's sort of like, is self-custody therefore DeFi and exempt? I think is a big thing for Figure.
Yeah, it seems like it's very clear that the market structure debate is like an order of magnitude more complex and contentious than what the Genius Act was. Despite kind of part of it actually being relitigating the Genius Act and in the yield side of it. And so it's been really interesting to see the arguments that different sides are making. But I think as of yesterday, it seems clear that Coinbase isn't supportive of the direction that it's been going. And now we'll see what happens when everyone regroups and comes back. But I think it's going to take a lot more debate and discussion. And frankly, I think part of the challenge is this stuff is still really new. Like, understanding stablecoins and how they work and like what the yield and reward products are, and
Totally.
like thinking about the second, third order effects of what would happen with the yield if you block it, where does it go?
Right.
And that's just like the yield. Then you get to DeFi, and you're like, how many banks have spent meaningful time really understanding DeFi? Not many, because it's new.
Right.
It's like brand new, and it's super complicated. And so I think anytime you have something that has potentially significant implications that is also really complicated from both like a technology standpoint, from a kind of risk and regulatory standpoint. It's just it's hard. And I think it takes a long time to really understand and try and find compromises and come up with good policy in these emerging areas.
For sure. I for one hope we can get some put to bed of the yield conversation, because we've been sort of doing this rewards model for a couple of years before Genius Act. I think it's going to continue now. The sort of throwing this into the market structure bill just complicates an already complicated bill. And meanwhile, there are businesses like Figure and many others that don't really have regulatory clarity and are trying to do the right things and trying to prevent risk and trying to do the right things for consumers in the marketplace. There's lots of policy guidance that has come out of the SEC and elsewhere, but a change of administration could change all of that. So we do need something on the books. I suspect that would be very helpful. One last story and we'll wrap up for this week, which is Polygon acquired both CoinMe and Sequence for a total of about $250 million. So CoinMe is a crypto payments business, while Sequence is a wallet infrastructure business. And this also includes a number of licenses and MTLs in 48 states. And the deals will be anchors to the Polygon Open Money Stack, which is a framework for supporting stablecoin-based payments. But they have like this Open Money Stack, so everything's replaceable, even though they own these two parts. The idea and what they say is, look, if you're brand new to stablecoins, you can sort of almost pick and choose from this Open Money Stack. And if you need the licensing, we can offer that to you as well. And Polygon's doing a lot of volume in payments. They're one of the largest chains for payments, and kind of interesting to see they've got John Egan now, who left Stripe to go join those guys. Kai, Michael, any thoughts on this story and the M&A that you're sort of seeing in this space? Is that a sign of maturity? What are your thoughts?
From my perspective, it's kind of, I always think about, because I started in financial services, fintech experience, a lot of what you see in blockchain and crypto is rebuilding financial services in a new way. And so I think what you're seeing across the ecosystem is people want to have more and more functionality, but they're still doubling down on what they do best. And so people are there. You have this M&A because there's a lot of adjacencies as you build platforms and ecosystems. It's almost like banks, right? Like banks, there's kind of like, they specialize in things, but then there's just a set of services that people are ultimately looking for when they go to a bank, or certainly when they did go to a bank, call it 50 years ago. And so when I look at Figure as an example, and we were kind of having this conversation with Provenance and RL1, it's like, we're the best in the world at tokenizing assets. But then at the same time, we offer crypto trading, right? Because some people want to lever what we do or what they own and use and maybe loop or trade with us, or they might want to, now we have equities, right? And so there's things that we do, like you kind of come for the tokenized assets, but you might stay for something else. And so I think that you're seeing that across a lot of these M&As that have been happening. Definitely Ripple's been active. A lot of people have been active, and people are trying to take the lead that they have and expand into other areas. I mean, Gemini has a card, right? They didn't necessarily buy that, but another example.
A lot of expansion, Kai.
Yeah, I think it's going to be a trend that we see more and more, and it's an interesting question of what does the future like business look like for blockchain foundations. And blockchain foundations have been around for a while. And I think in the early days, I remember Polygon used to do developer grants, and they'd go out and try and convince enterprises to build on the chain. And I think we're getting to a point where you have vertical integration happening from multiple angles, and it's increasingly hard to just go and say, hey, like, please build on a chain. And so what some of these foundations are doing is they're saying, you know what, let's build a full stack product suite that uses our chain, and let's go out to enterprises and let's sell that product. And so you accomplish the same goal of like getting people on the chain, but instead of having to convince third-party infrastructure providers to natively support and really promote and preference your chain, which is incredibly hard because many of them are creating their own chains. And so it's like, as the infrastructure providers have their own chains that they're integrating in, anyone who is a chain that doesn't own any infrastructure that's kind of end customer facing is now going to have a harder and harder time competing. And so it makes sense that they do the reverse. So they say, okay, we need to have something that an enterprise can plug into. So I think it's a smart move. And I think it's only the beginning that we'll see more foundations morph into actual like payment infrastructure businesses, whether it's spin out, whether it's acquisition, and I think it's a general direction of travel.
Payments was always a great business. It's interesting to your point. We're not seeing the big deals with Nike or Starbucks so much, but now we are seeing like payments volume and revenue, and it's something Poly Market is on Polygon, and there are these sort of things now that are generating real volume for them that are starting to look like real businesses. And I think that's the theme today. I mean, Figure's probably the canonical example of a real business that happens to use a blockchain. There are many others now emerging. A bunch of stories we didn't have time to cover this week. There was so much news. M-Pesa partnered with Blockchain ADI to roll out blockchain-powered transactions in 8 different countries, M-Pesa being one of the original mobile money wallets. BitGo is seeking $200 million in its IPO. X is developing smart cash tags to link ticker symbols to financial data. BNY is intending to issue tokenized deposits. Ripple got an approval from the UK regulator, and shout out to Wallet Connect, who did a partnership with a real payments OG in Ingenico to make Wallet Connect available at their 40 million terminal locations. You've probably seen that Ingenico thing if you've ever gone to Tap to Pay. And then, of course, Galaxy launched the first ever CLO on Avalanche, anchored by a $50 million allocation from Grove. So we're seeing those private markets start to evolve. You could imagine we could do like a 3-day show here and not get into all of that with the level of detail it deserves. So I want to thank you, everybody who kept up with us today, who always watches. And I want to thank Michael for joining us. Where do people go to find out more about you and find out more about what Figure's up to?
Absolutely. So if you want to hear more about the tokenized equity, it's blockchain equity at figure.com. I'm M. Tannenbaum at figure.com. And I'm on X, although I don't have that many followers, but I have a lot on LinkedIn. So either one.
And Kai, how about you?
On X at Kai Sheffield and visa.com/crypto.
You'll find me at SY Taylor on all of the socials. You'll find me at fintechbrainfood.com and, of course, at tempo.xyz. And you'll find me asking you once again to subscribe, like, and do all of those things and tell everybody you know about this show. It really helps us. Thank you very much. Bye for now.